Hey, this is Chris Franco, and you are listening to Compound Money Quietly, the CMQ Investing Podcast. CMQ investors, welcome to the show. It's great to have you here. But you know what's not great? Inflation. According to the Wall Street Journal, the U.S. economy's rebound from the pandemic is driving the biggest surge in inflation in nearly 13 years. In this episode, you will acquire timeless investing wisdom from Warren Buffett and Charlie Munger about how to deal with inflation. My goal is that by the time you're done listening, you'll be less anxious, you'll be less worried, and you'll be more informed and prepared to deal with whatever comes. So let's get into it. The year is 1988. We're in Omaha, Nebraska at the Berkshire Hathaway annual shareholders meeting. The inflation rate is rising. And the reason, according to Warren Buffett, is because printing money is just too easy.
Sounds familiar. Jerome!
At the meeting, several shareholders asked Warren Buffett and Charlie Munger for their advice about how to hedge against inflation. Every suggestion or every, potential solution that people threw out, what should I do? Should I try this?
Bitcoin.
Basically, they just got shut down. Let's start off with leverage. To that, Warren Buffett said, "You can leverage up to your eyeballs, but you may not make it across the river. How about foreign currencies?" Charlie Munger says, "It's hard enough to understand the culture you've been raised in, much less someone else's." And finally, hard assets. Here's what Charlie Munger had to say. "Someone figured out the Van Gogh painting that sold for $40 million last year yielded a 13% compounded annualized return. Berkshire shareholders have done much better. So what should we do to mitigate the effects of inflation? According to Buffett and Munger, the same thing you should do if there was no inflation. Buy great businesses with excellent management at a fair to bargain price and leave them alone." Warren Buffett acknowledged that, yes, inflation is undesirable, but well-run businesses that employ relatively little capital, businesses that throw off lots of cash, that have pricing flexibility, those businesses will cope well with inflation. 16 years later, at the 2004 annual meeting, a Berkshire Hathaway shareholder asked the following question, and I quote, "What advice would you give to investors who need to preserve their capital and their purchasing power in such an environment, an inflationary environment?" Warren Buffett was the first to respond. "Charlie and I think the best answer is to own fine businesses that will be able to price in inflationary terms and will not have huge capital investment that is required to handle the larger dollar volume of sales. Unfortunately, most businesses will not come out well in real terms during inflation. Their earnings may go up a fair amount over time, but they're compelled to put more and more dollars into the business just to stay in the same place. The worst kind of business is one that makes you put more money on the table all the time and doesn't give you greater earnings. So you really want a business that can have pricing that reflects inflation and does not have very much capital investment that reflects inflation. But inflation is the enemy of the investor in terms of real returns." Charlie Munger said, "Yeah, most people are going to get a very small real return from investment after considering inflation and taxes. I think that's an iron law of the world, and if for a brief period some of us do better than that, we ought to be very thankful. One of the great defenses to being worried about inflation is not having a lot of silly needs in your life. In other words, if you haven't created a lot of artificial demand to drown in consumer goods, you have a considerable defense against the vicissitudes of life." End quote. If you'd like to read the transcripts, if you'd like to have more information about what we discussed, sign up for our newsletter at cmqinvesting.substack.com. All of our subscribers receive a brand new newsletter post in their inbox as soon as a new podcast is released. Once again, cmqinvesting.substack.com. If you have any questions about this episode or just questions you'd like for us to answer in a future episode, send them to franco@cmqinvesting.com, franco@cmqinvesting.com. Now, I don't have all the answers, and I certainly don't think I'm an expert on inflation, but I believe that these two examples that we cited from the 1988 shareholders meeting and the 2004 shareholders meeting offer some really valuable wisdom that still applies today. Here's my personal opinion based on my research and just from the process of producing this episode. Remember, this is just my opinion. This is not financial advice. I'll share this with you, and then we'll get into one last thing that I was told I need to keep. So stay tuned. The only thing you should worry about regarding inflation is being induced to do something irrational because of inflation. Because inflation's a time for people to come around and start trying to convince you to put your money in all sorts of just random stuff. You know, you need to buy bronze. Or as we heard earlier, you know, buying a Van Gogh painting or foreign currencies or even, you know, Dogecoin.
Hi, it's me, the overconfident investor. I just want to say, don't listen to a word that guy said. Just buy Dogecoin, okay? I bought the dip twice. Call me double dipping. I'm so rich. I consider myself a long-term investor. I buy a stock and I hold it until I don't like it anymore. And then I sell it, usually for a loss. But who cares? So much fun.
This has been Compound Money Quietly, the CMQ Investing Podcast. My name is Chris Franco. Thank you for listening. We'll talk soon.